So again, this training is really to help economic development officers understand their clients better, but also to how we can help them to be more profitable. So these three sessions are going to be based on that. So the first thing we need to do is really look and understand financial statements. It's still, it still boggles my mind how many people really don't understand what the financial statements are telling them. And it comes from different backgrounds. So without further ado, we're going to do a couple of things. So, whoops, sorry. Let me. So we're going to look at defining the key components of the balance sheet because I've worked with over 10,000 businesses, in the last even just 11 years, prior to retirement, of course. And in probably 95% of the cases, the balance sheet is misunderstood and it's misrepresented. And I'm talking, when we're looking at accountants helping clients, well, you'll see if you look at financial statements, most financial statements, well, you'll have revenues and you'll have cost of goods, maybe not, and operating expenses and a net profit. So more or less, they're there to support CRA and providing financial information to CRA in the financial statements, but in a condensed state. But entrepreneurs need more information than that in order to make informed decisions, how to price their product and services properly, and also how to make a net profit. Because a lot of times I'll ask, what kind of discussion have you had with your accountant at year end on how to improve the profitability of your business? And in most cases, people said that we've never had that discussion. So then we're going to look at recognizing and properly applying the two types of depreciation. This is really critical because I see this as an issue in almost every business I've worked with. So I just want you to understand that. And again, it's moving forward so you can help your clients. We're going to look at the importance of establishing a capital account. Now, a capital account is there in order to, once the business is profitable, this is a great tool. And we're talking about, these are the type of things that the best in sector companies are actually doing across not just Canada, but internationally. So we'll talk about that. And then we're going to talk about using the income statement to make informed decision. And again, probably in a very large number of businesses, we've had to modify the income statement. So it gives actually the entrepreneurs the information they need in order to make those informed decisions. So let's take a look at the balance sheet first. Very simple. It can be a corporation, it could be a co-op, it could be an individual, a sole proprietor. Basically, the balance sheet is a snapshot picture of the financial situation at a specific date and time. So from a sole proprietorship, it'd be your net worth statement. As a corporation, it's still what the value of the business is on paper. All right, so let's go to what are the components of that balance sheet. Basically, we have assets, and there's always two types of assets. There's current assets and fixed assets. And we'll be looking at this a little in more detail. We have liabilities, current liabilities and long-term liabilities. And then we have equity, shares, retained earnings, and current earnings. Again, we'll discuss this a little bit more. But if you look at assets, in layman's term, it's everything you own. If we look at liabilities, it's everything you owe. And if you take everything you own minus everything you owe, you're left with equity. That's a very simple explanation of what that balance sheet is. Unfortunately, again, in a lot of cases, the balance sheet is not properly represented, and this is where we're going to look into those details. So let's look at current assets. A very simple definition of current assets is anything that can or can be converted into cash in the next 12 months. This is important because I've seen balance sheets where long-term assets are in current assets and current assets are in long-term assets, and it's a little bit mixed up. And this becomes very critical, especially when you're doing some analysis and wanting to make sure that does the company have a solid cash flow. So this is where it's important to understand what are the elements of the current assets. So current account, bank account, that's cash, petty cash or cash on hand. Accounts receivable, hopefully that's somebody who will pay you within the next 30, 60, 90 days. So it is something that we converted into cash in the next 12 months. Inventory, typically it's supposed to be converted into into cash in the next 12 months. Now, if you're into the cruise line industry, well, it takes 3 years, 4 years to build a cruise ship. So this does not apply. But for the businesses we're talking about, inventory is basically things that you'd want to convert in the next 12 months. Prepaid expenses, sort of like insurance. Even like in prepaid expenses, and this is where a lot of people are not doing that. If you really want to understand your if you're making money or not, if you're profitable or not, when you look at the profit and loss statement in your business, if you look at it on a month-to-month basis, are you actually making money or not? Well, to give you an example is that if you, let's say you got an insurance bill and it was January 1st and it's for the next 12 months and it's $1,200, a lot of people just expense it out in the month of January. So you got a $1,200 expense in January. Well, what's going to happen to January? Your net profit's not going to look so good. But that's for the next 12 months. So people should be applying that over the months that they're actually that they've actually bought the insurance for. But the same thing applies with property taxes, because you only pay them once a year, but it's for the whole year. And look at it this way. If you sold a business, let's say 6 months into your year, and you've paid the property taxes for the whole year, you will get back for 50% of your property taxes because you've only had the property for 50% of the time. The same thing with insurance. If you cancel your insurance 6 months into the year, you'll get back a credit for half of the year. So the prepaid expenses are critical, the way that you account for them in your financial statements, both on the balance sheet and both on the income statement, because this is critical. Again, if you're going to be looking at your income statement on a monthly basis, are you really making money or not? And this is where a lot of entrepreneurs don't even bother looking at financial statements because they can't tell if they're making money or not. So this is one of the reasons. And then we have investments. Now the investments would be, hypothetically, we're trying to get every business to make a reasonable net profit. And a reasonable net profit to me is 10%. If you would make 10% net profit in your business on an ongoing basis, you will never have to worry about money. You'll never have to worry about bills. Everything will be taken care of, and your business will be very sellable as well. But in a lot of cases, as you've heard me before, some of you, is that over 80% of the businesses, not just nationally, but internationally, make less than 1% net profit. And that's the reason why nobody wants to buy them. And a lot of people are having difficulty getting financing in order to finance their business. And lastly is the capital account. It's sort of like the rainy day fund. So the capital account, again, this is what successful businesses are doing, is that when we look at depreciation is what we call a non-cash outlay expense. So we buy something and we depreciate it over time. And so the amount of depreciation is actually an expense that goes onto your income statement, and it's a legitimate expense, but we didn't actually pay out cash for it. So what these companies are doing, the successful ones, is that what they do is they actually take the amount of depreciation out of the current account, out of that bank account, so that they don't use that money for operations. So they take it out and they put it into a capital account, because eventually you're going to need to replace that asset, or you're going to have to repair that asset. And a lot of people, if you're only making 1% net profit, you're always borrowing money in order to buy a new asset or to repair an asset. This way here, you're starting to finance yourself. Again, this is what very successful businesses are doing. And the capital account is also used to accumulate depreciation. Because if you just wait till the end of the year, a lot of people I see, you look at your financial statements, your income statement especially, and you see profits. All of a sudden, let's say you've got $40,000 net profits at the end of the year, and then you send everything to the accountants, and then they're going to take 3 to 6 months to provide you financial statements, and they just tapped on a $50,000 depreciation. Well, you thought you were making $40,000, now you're losing $10,000. You got a negative net profit. So this is why it's important that we need to capitalize on our accounting, and we understand what the financial statements are telling us, but that they are up to date. Remember, the balance sheet is a statement of your financial situation at a specific date and time. So if you haven't done the depreciation on a monthly basis, if you haven't done the prepaid expenses on a monthly basis, then your balance sheet is really not at that date and time because it's not finalized. Fixed asset is anything that won't be converted, typically won't be converted into cash in the next 12 months. So like some people will say, well, if I'm going to sell my vehicle this year, isn't that considered a current asset? We're talking using common sense. These are assets that are long-term, have a long-term life expectancy, more than 12 months, and typically you're not going to convert them into cash. There is some accountability when you do sell some equipment or you upgrade some equipment, but we'll get to that a little later. So fixed asset, so current assets is anything that is or can be converted into cash in the next 12 months, and fixed assets is anything that will not be converted into cash in the next 12 months. Then we have the current liabilities. So the current liabilities is everything that we owe in the next 12 months. So now you can start to see current assets is everything that is or can be converted into cash in the next 12 months. And current liabilities is everything we owe in the next 12 months. So what you want to do is you want to have more current assets than current liabilities. If you have more current liabilities than current assets, you're in trouble. You've got a cash flow problem. Your cash flow problem is worse because you don't have enough money to pay the ongoing expenses on a regular basis. So under current liabilities, we have accounts payable. We have credit cards payable, lines of credit. Now, I've seen sometimes people put lines of credit into the long-term liabilities, and they don't belong there. Because the reason it's in the current liabilities is because the bank can call upon them anytime they want. Taxes that are due, payrolls and vacation, and current portion of long-term debts. That means whatever is owed in the next 12 months on the loan that is longer than 12 months. And again, in a lot of financial statements, I sometimes don't see this current portion of long-term debt. It's simply all incorporated into the long-term liabilities. And it just gives you wrong information. We'll look at this a little later. Then we have the long-term liability. So this is anything that we owe in the next 12 months. And this would be mortgages, equipment loans or vehicle loans, other loans, shareholders loans with no specific payment terms. So this is where, again, shareholder loans, this is another one that sometimes I'll see in current liabilities. Well, that would mean that the shareholder wants their money back in 12 months. If that's the case, that's fine. But if there's no notes to the financial statements that indicate that the shareholder's loan is to be repaid in the next 12 months, it does not belong in current liabilities. Again, these are some of the things that I just see and I've been seeing on a regular basis with a lot of financial statements. So when you're looking at it, just keep in mind how it's supposed to be structured and if the things are in the right categories. Because before you start to make an analysis and to determine what are the areas of concern in the business, we have to make sure that these are correct. So in a lot of cases, when I would do some analysis for businesses, I would need to sort of normalize what you call the financial statements to put the things in the right order, even though they were prepared by a chartered accountant. So just keep that in mind. And then we have the difference, well, the equity is, like I said earlier, is the difference between what you own and what you owe. So the initial investment, so let's say you just put in $10,000 to start the business of your own money. So that goes in there. Retained earnings. Now, if it's a corporation, retained earnings are profits or losses from previous years carried forward. Current earnings are simply year to date in our business, what are the profits at that time? So it gives you, so the equity basically is those three categories. So any questions up on that point? Pretty clear, straightforward? Okay, very good. All right, so let's take a look at some important things to keep an eye on in the balance sheet. So the ratios that are important, to me anyway, I mean, there are hundreds of ratios that exist, and I always use Pareto's law, which is the 80-20 rule, meaning that 20% of the ratios will resolve 80% of the company's issues, if you understand what they're telling you. So to me, as we talk about on the balance sheet, especially the current ratio, the quick ratio, the accounts receivable turnover, how quickly are people paying you, the inventory turnover, how quickly our inventory is turning over, and the value of the assets. Now, this is really interesting because the value of the assets are typically way off than what actually the owner thinks that it's worth. So, and this will come back to how we look at depreciation and understanding the different types of depreciation. So let's take a look at the current ratio and the quick ratio. When we look at the working capital, which is cash flow, is basically your current assets minus your current liabilities. We talked about that a little earlier. Do we have enough money to pay off our currently financial obligations that are due within the next 12 months? So when we look at the current ratio, it's a key measure of the overall liquidity position of the company. So the higher the current ratio, the better you are. The lower, it indicates some signs of problems. So a business with inventory, that ratio should never be less than 2 to 1, meaning that for every dollar of current liability that I owe, I have at least $2 of current assets to cover it. That would be the minimum, okay? So this is what we're looking for. So this is why it's so important that we understand what current assets are and what current liabilities are, and making sure that things are in the proper category. So if we look at, I'll give you an example, a very quick example of where I've seen some people make this mistake. So if we look at current assets, let's say that all of a sudden you need to buy a piece of equipment that's $5,000. Well, you don't have the $5,000 in your bank account, so you're going to go use your line of credit. So you take your line of credit, you take $5,000 from your line of credit, and you buy this piece of equipment. Now, the piece of equipment is not a current asset. It's actually a long-term asset because it's a piece of equipment that will probably have more of a 12-month life expectancy. So what you've just done is that you haven't increased your current assets because it goes into the fixed assets, and you've actually just increased your current liabilities. You owe that money. That line of credit could be called upon at any time. So all of a sudden you start to get into a panic because you don't have the cash flow to support everything. We haven't increased our current assets, but we've increased our current liabilities. So this is where the current ratio becomes very important. The quick ratio, it's simply, or the asset test, it excludes the inventory. Because if you needed quick money, this is why we call quick ratio. If you needed quick money in order to pay something, well, bank account or current account, that's cash. Cash on hand, that's cash. Your accounts receivable, hopefully within the next 30 or 60 days, that'll come in very, can come in more or less quickly if you work on it. But the inventory is really vulnerable. I mean, you're not necessarily going to be able to convert inventory in the next 30, 60 days in order to generate cash. So this is why we simply take the inventory out of the equation and we do the calculation again. So current assets minus the inventory over current liabilities. And this one, it should never be below 1 to 1. So this is where it becomes critical in understanding the two types of ratios, especially the current and the quick ratio, to see if there are any cash flow problems. Now, that doesn't tell us where the problem actually is. It just tells us we do have a problem. So again, looking at that quickly, and if the balance sheet is well structured, you as economic development officers, if you are getting your financial statements from your clients on a regular basis, and believe me, we are there to try and help our clients. So when we're asking for information from them, it's to help them get ahead of the game so they don't have to wait till there's a doomsday situation with their business, and now they're looking for help from you. So we need to be helping them all along the way and how they can improve, be profitable, and to contribute to the economy. So this is where we want this type of information. So you could quickly do the calculation in about, 15 seconds. If you look at the current assets and the current liabilities, you just do the simple division, where are we at any given time, but they have to be up to date. So again, we'll look at that a little later. So coming back to the current assets, current liabilities, just showing you what we have on both sides. So it's the current assets divided by the current liabilities. For every dollar of current liability that we owe, we want at least $2 in current assets to cover it. So again, lines of credit should be used sort of to finance inventory, but lines of credit are being used to do a whole bunch of other things. And when I look at accounts payable, I also include credit cards. When I do my calculation of accounts payable turnover, is that the credit cards were probably used, and I'll ask the question to the clients, did you use your credit cards in order to buy inventory? Because they want to have the points and everything else, so they use their credit cards, or the credit cards is on hand with the suppliers. So the credit card that's due and the accounts payable that's due, I use those together. And if they're using their line of credit in order to also purchase inventory, then I will include, for the accounts payable portion, I will include credit cards and line of credit, put all of those three together. That's really my accounts payable. So again, it gives you more information when you're doing analysis, but these are the discussions you can have with your client. And these are the type of questions you should be asking. Are you using your credit card in order to purchase whether it's goods or services? And the same thing with lines of credit. All right, so let's take a quick look. And this is an actual company that I worked with. So the current assets in 2018 were 466,000. In 2019, 304, and in 2020, 274. So that's going down. The current liabilities are also going down, 368, 278, and 261. If we look at the current ratio, in 2018, it was 1.26 to 1. So in layman's term, what this means is that for every dollar of liability, current liability, I should say, that I had in the company in 2018, at the end of 2018, I only had $1.26 to cover it. And this company had inventory. So definitely, it looks like there might be a situation here. But it's getting worse. So, and what you're trying to do when you're doing some analysis is just don't look at the current year or the year that you're looking at. If the business has been existing for a while, try to go back at least 5 years. The reason I say that is that you want to try and find what year were they actually doing well. Because once we can determine what year they were doing well, then we have, again, this Pareto's law, 20% of the ratios will resolve 80% of the business problems. And we take those 20% of those ratios, those 9, 10 ratios, it will tell us, okay, what were they doing well in that year? And can we replicate that? So when we're talking to the client, okay, this is what you were doing in this year, and this is where you are now. So this is what has changed. How do we get back on track? And this is where you want the client to commit. So we could do this, we could do that, we could do this. So at the end of this presentation, I have actually a list, not this necessarily company, but a company we'll be doing the case study on next week, is that I have a whole list of things that we discuss. And by making those changes, we see some dramatic results in their financial situation. Now, when I say go back 5 years, if the situation hasn't been good in 5 years, I'll tell you, I had one company, I had to go back 20 years to find a good year. So for the last 19 years, they were losing money. He had built up a lot of equity over time, but it was dwindling down to the point where he was actually in a negative situation. So don't wait till you're using up all your equity. If things are going bad, make changes now in order to turn the situation around. If you wait too long, you're going to get in trouble. So if we look at the liquidity ratio now, which is the current assets minus the inventory. So now in 2018, the quick ratio was $1.21. So the current ratio was 1.26 to 1, and the quick ratio was 1.21. So again, that means that for every dollar of current liability, I had $1.20 to cover it without the inventory. So, and again, here we're looking for a minimum 1 to 1. So this is one of the reasons why in 2018 there wasn't a cash flow crunch, but it was starting to get tight. In 2019, it went below 1, just basically 1. So it was still okay. But in 2020, 0.85, that's why the situation got worse. And this is why now for every dollar of current liability that I only have 85 cents to cover it. Well, when you're sending this information, let's say you have a mortgage with a company. Well, as soon, or with a chartered bank, as soon as the bank starts to see your current ratio is 1.05 to 1 and your quick ratio is 0.85 to 1, and you've been with the bank for the last 4 or 5 years and they see this going in the wrong direction, they're going to call the loan. And this is when they come to the CBDC. Well, I need to borrow money because the bank is after me in order to, they're calling the loan. So this is where, again, let's not wait till we get to that situation with businesses. So what we started to do was, okay, well, let's take a look and see what caused some of this current ratio and quick ratio to go haywire. So total sales in 2018 was 795,000. And in 2020, sales had increased, to 1.166 million. Really good increases compared, to the time of where we're at in the economy. And the current account went from 108,000 to the plus to a minus 75 to a minus 80. So again, this is where when I see the current account at minus 75, and again, this is in financial statements, so you got to look at what the information is telling you. If you are minus 75,000, that means that you're into a line of credit of 75,000. It does not belong in the current account, it belongs in current liabilities. So this is where, again, people get mixed up. Why do I have minus 75,000 in the current account? Well, that can't be unless I'm using a line of credit. So the categories are wrong again. I mean, I put it here, it's minus 75,000, but that 75,000 should be a line of credit into current liabilities, not in the current account. So again, this is where things are skewed. The average inventory, we went from 17,000 to 23,000 to 51,000. Accounts receivable, they went from 331 to 210 to 218. So it has calmed down a little bit, but in 2020 went up a little bit more, but a big change from 2018. Average payables was 357,000 in 2018. So look at it this way. If people aren't paying you, your accounts payable are going up because you don't have the cash in order to pay out what you owe. So in 2019, accounts payable were 261, and in 2020 they were 209. When your accounts receivable are lower than what you owe, that is also an indicator of a problem in the company. Okay, so money's not coming quickly in order to pay that down, so you're getting into trouble. However, in 2018, with 795,000 in sales, they had a net profit of 9.86%, a $78,000 profit. So then in 2019, they had a net profit or a loss of 3.97%. So, and then back in 2020, it started to come back up again. So let's find out what maybe the problem could be. So this is, again, when you're doing your analysis, you start to look at, okay, what makes up the current ratio and the quick ratio? So then I look at the accounts receivable turnover. And again, we have to look at net credit sales. The reason I say net credit sales is simply because a lot of businesses, they have cash sales and they have credit sales. So if you are doing business and 50% of your revenue comes from cash sales, people are buying from the cash register or whatever, and the other 50% is that they simply mark on credit and then they pay later, well, you can't take all of your sales divided by your average account receivable, because only 50% of your sales are actually credit sales. I think you understand a little bit where I'm coming from. So, but we need to ask that question, because that information will never be, it won't tell you on an income statement, and it won't tell you on the balance sheet, and it won't tell you at year end with the financial statements from the accountants either. So you need to ask the client, how much of your sales are credit sales and how much of your sales are cash sales, in order to be able to make this calculation, correct calculation. So to give you an example, if we take 2018, sales were 795,000, average account receivable was 331,000. So the accounts receivable turnover is 2.4 times. So the average client would take 152 days to pay their bill. So this is why there was a high accounts payable as well, because they don't have the money coming in order to pay their bills. So there was definitely a problem with accounts receivable in 2018. In 2020, the situation got a little bit better. Sales were 1.1 million. Accounts receivables were 218,000. The inventory turnovers was 5.3 times per year. So now people were paying on average 68.9 days. So if we look at, what happened 2018 to 2020, it certainly wasn't in the accounts receivable area. It's getting better. So they're doing something there. So that's not where the cash problem arose, and that's not where the current ratio and the quick ratio went array. So now let's look at, so this is something, I do this in my workshops all the time. So if you sell on credit, you will never, never, never collect 100%. Get that through your head. You will never collect 100% if you sell on credit. Some can't pay and some won't pay. And I've learned this from experience, and I've also seen this in almost every business that I've worked with. So let me give you an example. So let's assume someone owes you $450, not a whole lot, and you can't collect. And this actually happened to us when we had a grocery store. We had somebody to come in, and and we weren't giving credit, but this is what the situation happened. A gentleman came in and he bought some groceries for $200, and he got to the cash, and there was a junior clerk that was there in the evening, and he gave a check from the government of Canada, a UI check for $450. So she took the check, took the $200 off the groceries, and gave him back $250. So the next day, we deposited that money in the bank, and then we get in the afternoon, we get a visit from the RCMP. This check was stolen. It's going to be included in evidence, and that money did not go into your bank account. So I actually lost $450. Now, I know that over 80% of all businesses, not just in North America, but across the world, make less than 1% net profits. So let's assume we're one of those companies. How much do we need to generate sales in order to make up our $450 loss? And this wasn't even our fault. We just accepted a bad check, but we didn't know it was stolen. So if the clerk would have asked for ID, we changed the rules after that, but it happens. So just to let you know is that we need to sell for $45,000 in additional sales in order to recoup our $450 loss, simply because we're making less than 1%, we're making 1% net profit. I have to keep an eye on the time here. So this is why it's so critical that you need a credit policy if you're going to sell on credit. And make sure you do your due diligence. There's whole things we can talk about, making sure that people do credit checks and making sure that they fill out the proper application and everything else, but you can minimize it, but you will still never collect 100% if you sell on credit. So this is coming back to when you're doing budgets and you're doing some pricing and all of this. Well, whatever you lose, let's say that you lost 1% of sales to bad credit. Well, this becomes part of your pricing strategy. So when you're pricing your product, you're going to add 1% for those people who can't pay. Unfortunately, everybody's going to have to pay for the one person who doesn't pay. But again, doing your due diligence, you can minimize your losses on credit sales, but you still will have some credit sales loss. So now let's take a look at the inventory, checking the inventory. Is that the problem area for our current ratio? And again, the current ratio includes the inventory, and the quick ratio does not include the quick ratio, the inventory. So let's take the example. So in 2018, we had $17,000 in inventory. We purchased $500,000 in goods that year. So the inventory turnover was 28.08 times per year. That means that we had on average 13 days of inventory on hand. So our inventory was really turning over quite quickly. So if we look though, let's take a quick look at cost of goods. I don't have a slide for it, but so if we purchase $500,000 in goods, and our sales were what, 795,000 in 218. So if I take 500,000 divided by 795, more or less, so our cost of goods was around 63%. Meaning that for every dollar of sale, it costs us 63 cents in product in order to generate those sales. So the inventory was turning over quite quickly, so we weren't holding a whole lot of inventory. We're buying. We weren't actually paying for it because our accounts payable was right off the charts, but we were actually maintaining a low inventory, probably because we didn't have the cash flow to support a higher inventory. Now in 2020, our inventory went up to 51,000. So that's almost triple what we had in 2018. So the turnover is 12.78 times per year, which means we have inventory for about 28 days. Still not bad. But if we look at the cost of goods now, because remember, in 2018, we had a net profit of around 10%. In 2020, our net profit was around 3-4%. But in 2019, we had a loss of 3-4%. So if we take the cost of goods, let's take the 660,000 divided by, it was 1.16, I think, million in sales. So the cost of goods was actually 57%. So in 2018, for every dollar of sale, it costs us 63 cents in product. In 2020, for every dollar of sale, it cost us 57 cents. Well, the difference between 57 and 63 is 6 cents. So that's 6% difference that we were able to recuperate in 2020 just on our cost of goods. So that's not where the problem was. So it wasn't really on the inventory and the cost of goods that our current ratio we had an issue with. So now, one of the things though on inventory, what you want to do is that you want to have enough inventory that you're not going to run out, but you should review it frequently. And you also, how much should I order and when should I order? And how much should I keep on hand? The company that we're going to be doing the case study on next week, the company had about $175,000 worth of inventory. But the thing is, when we started looking at it, it's still the 80-20 rule here in inventory, is that 20% of your inventory is going to generate 80% of your sales. So we started looking at this gentleman's inventory, and he had pieces of equipment that were like $5,000, $6,000, $10,000. And I said, well, how much of these units do you have? Well, I have 4 on hand. Why do you have 4 on hand? Well, somebody set me up with an inventory system with a minimum maximum. So whenever it gets below a certain amount, it reorders automatically. So it was sort of like an automatic system. Well, I said, how many do you sell a year? Well, he says, I've only sold like 1, maybe 2 a year, but you have 4 on hand. I said, so that's around $40,000 worth of inventory you have on hand, which only you're going to use 20,000 in a year. How quickly can you get your inventory, this certain part, how quickly can you get it in? Says, I can get it in between 4 and 5 days. So I said, why would you carry 4 pieces of this inventory and only having to use 1 or 2 a year, and you can get it in 5 days? So that sort of rung the bell. We need to reduce our inventory. So he changed the minimum maximum, but when you let somebody from the outside do some of this stuff, you sort of take it for granted. But then when you're looking at it internally, you're the business owner. So we just said, okay, bring it down to 1, minimum 1, maximum 1, meaning that if you sell it, you reorder it because you're going to get 1 in 4 or 5 days. What are the odds that you're going to need 2 in the same 3-4 days? And he says, practically none. And if that would be the case, it's just going to be 2 or 3 days to wait. So this is where, again, inventory control, we have to really be careful not to have more than we need, but to also make sure that it's turning over in a reasonable amount of time. So we'll have more to deal with that when we do the case study next week. So inventory wasn't the issue. Accounts receivable wasn't the issue. So now we took a look at calculating the labor costs. Now the labor cost doesn't really have anything to do with the current assets per se, But what it does is every time we're paying labor, it's depleting our current account. So you got to look at also the expenses that we're using. So you got to keep in mind that in any business, it doesn't matter what kind of business, if it's a manufacturing, if it's retail, if it's service sector, a good 2/3 of your expenses will be labor and materials. If you're in the service sector, it'll be mostly labor. If you're in the retail sector, it'll be mostly cost of goods with some labor. If you're in the manufacturing sector, it'll be about 50% labor and materials. So looking at that, is labor and cost of goods are your two biggest costs in any business, and these are the ones you have to control. So let's take a look here. In 2018, with our revenues of $795,000, again, remember that we have accounts receivable of roughly $300,000, so 795 total sales, that's fine, but we don't have the money in the bank. Labor cost was 152,000. As a percentage of sales, it was 19.1%, meaning that for every dollar of sale, it costs us 19 cents in labor to produce that dollar of sale. So in 2019, with $1 million in sales, it went from 152,000 to 323,000 in labor expense. Now, for every dollar of sale, it's costing us 32 cents in labor costs. So look at it this way. The difference between 19% in labor costs in 2018 and 32% in 2019, the difference between those two is around 13%. Agree? More or less, 13%. So we look at the net profit margin. In 2018, it was 9.86%, roughly 10%. And in 2019, it was minus 3.94%. So almost all of our loss in net profits was due to increased labor costs. So now we have a labor problem. Now in 2020, they were able to bring our labor costs down to 26%. Again, it's basically, we spent 304,000 instead of the 323 in 2019 with even higher sales. So it brought our labor costs down as a percentage of sales to 26%. So the difference again between 2019, the 32%, and the 26% in 2020, the difference between those two is around 6%. And if we look at the net profit margin, another 6%. So the cost of goods actually was better in 2020 than it was in 2018 when we did that calculation. Remember, it went from 63% to 57%. But the labor cost actually is the culprit. So we're starting to regain some momentum here, but it's just to understand when you're doing analysis, and this is the unfortunate part, there's no common or generic, I shouldn't say generic, like you get your Sage and you get your QuickBooks and you get your Simply Accounting and you get all of those accounting systems do not provide you the percentages of labor costs, of material costs, of like it gives you general information, but it doesn't break it down into percentages. So this is why it's so critical that we need to look and understand what the balance sheet is, what the income statement is. We're going to look at the divisions of the income statement to extrapolate some information so it gives us information. If we just look at the numbers, well, okay, our sales went up by 700 from 795 to 1 million. Sure, our labor cost is going to go up, but as a percentage of sale, when you start calculating percentages, there gives you a very good picture of what's going on. So we need to convert things into percentages. So what I'd like to do now, just before we go on break, is to go to hold on. We'll go to the 5-year template, 2023. So I'm going to stop sharing this and I'm going to bring this. So everybody has received this. Now it's a template. It's got formulas in it, but you may want to manipulate it the way you want if you're half decent in Excel. But I'll show you what I mean by that because it provides you the percentages that you need. So I'm going to stop sharing this. And then I have to go to the 5-year template, which is this one, and I will share. Is that, everybody can see that?
Yes.
Yeah, okay, thank you, Shauna. Okay, so listen, these dates can be changed. So this would be, if you look at financial statements, getting them from your client, and I've got a I've only given you a template for 5 years, but I've got one for 4 years. I've got one for 3 years. I've got one for 2 years. I've got one for 1 year, just to make it simple, because here the averages, if it's only 3 years, this formula is for the 5-year average, but you can do just 4, 3, 2, or 1. And again, you can easily manipulate. You can just take some columns down, but you need to change some of the formulas. But however, is that, let's say that, let me just give you an example. So direct cost of wages. So here, well, let's go to 2018, and I think it was 152,000. I'm just using this as an example. Sales were 795. I forget the actual number. In 2019, it was like 1 million. And whoops, that's 100,000. So I got to go to 1 million. 1, 2, 3, one more. 1 million. And here was, I think, 300 and, hold on. I forget, it was 32 or 52. 323. So 323. And then the last one was 1166, something along that line. And then the labor was 304. 304, yeah. So as you plug these numbers in, just to show you, it's just a template, like I said. What it does, it converts the numbers here into percentages. So here you've got the direct cost, but you also got the direct wages, which is 19%, 32%, 26%. Don't look at the average right now because I don't have all 5 years. I've only got the 3 years. So this is where we need to convert all the financial information from financial statements into percentages, because it tells a better story. Again, for every dollar of sale, this is how much it's costing us in material. For every dollar of sale, this is how much it's costing us in labor. Or for every dollar of sale, how much is it costing us for insurance, or for telephone, or for taxes, or for whatever you want. It can give you as much detail as you want. So this here is basically taking the income statement and the balance sheet, and it'll do. So here we have total assets, total equity, we have the net profits, we have current assets, current liabilities. The quick assets is the current assets minus inventory. So once you plug in your inventory, it would automatically provide that. The average receivable. So as you plug in this information from the financial statement, it will populate all of these and just converting it into percentages. So it just makes it a little easier to analyze your client's information as you're seeing this. So everybody has received one of these. Again, there might be some odd, and most of the people that I know that I've worked with as far as economic development officers are pretty good with Excel. So, but it's just, when I was doing an analysis, once you start to plug in the 5 years financials in this, it can spew out the information. And I know Roland, Roland Plourde has already been doing a lot of work in this area, but it gives you those, it's the percentages that are critical. But unfortunately, there's really no accounting software that provides you the percentages that you need. And the clients don't normally look at percentages. They just look at the numbers. But to them, those numbers don't mean really anything if the numbers, they may be correct, but it's still, if it's not converted into percentages, it really doesn't provide you with what you're looking for. So this here, again, when we're looking at the categories, so this is going to just give you some typical overall information on direct cost of material. Like if I put materials in here, so let me say direct cost of materials here was 500,000, if I recall correctly. And hold on, let me get the cost of materials. I didn't want to plug them in right away because I just wanted you to see how this table works. Okay, yeah, so I've only got 2018 and 2020 for this, so let me go to 2020, and the cost of materials was 660,000. So again, coming back here now, the cost of goods was 82% in 2001, which is the labor cost and the material cost. In 2020, it was 82.61. Again, one of the reasons why it's still very high, but when we look, we brought our cost of goods materials down from 63 to 56, but our labor costs went from 19 to 26. So we didn't really gain anything. We actually went up in costs from a direct cost perspective. So again, you sort of got to go back. What I would look at, okay, a very simple explanation here. What I would look at is, okay, if I was able to run at 19% in 2018, then that's going to be my goal going forward into the future years. So how do I do that? So I got to monitor every dollar of sale and every dollar of labor that I'm spending on. Am I at 19%? We're going to look at the performance scorecard here towards the end of this presentation, but this would monitor on a month-to-month basis, are we at 19%? Because if let's say you're creeping up to 20, 21, 22, that means next month I got to do something. My labor cost is too high for the amount of revenue that I'm getting. So if I can maintain that at 19%, which was my best overall of the information that I have, and then I look at my cost of goods, I was at 63% in 2018, but I was able to bring it down to 56% in 2020. So I'm going to try to maintain that at 56. So if I take 19.12 plus my 56.6, now my new target for cost of goods is 75% instead of my 82. So look at it this way. If I bring down my cost of goods, both materials and labor, from 82 to 75, that is a 6 or 7% difference. Where does that 7% go? Right on your bottom line. That's the net profits. So it helps you understand. This is why we need to convert it into percentages. Don't worry about the numbers. The numbers will go up and down. Sales will go up and down. Costs will go up and down. But as a percentage of sale, that's where it's critical in order to maintain and to monitor that. Because if you can't measure it, you can't manage it. So we need to be able to monitor this on a regular basis. So this is just a tool in order to give you this is sort of like year-end stuff. Once the year-end is finished, you get this information, you plug in the numbers. But when you can go back 5 years, I say 5 years because that's usually, a good sort of realm of information. Try to pick what were the best years and the best results in mostly all of the categories. And if you can combine all of those best results, and one result might be from 1 year like we did here, the labor cost was better in 2018, but the material cost was better in 2020. So use those as sort of targets, as sort of goals that we want to achieve. And then that way there it moves forward. Does that make sense? And so I've got a sheet 2 here. The only thing is, this here is just when I'm working with making a report, which you'll see in the case study of next week, is that a lot of this information, so whatever we plug into the first page will actually be so here we have the direct costs of 2018. The reason I have that is I use this page in order to make tables, or to make not tables, but to make graphs, because a lot of entrepreneurs are visual. So if you see the graph going this way or going this way, well, to them it's more, the numbers sometimes people are not they don't see the numbers as being meaningful, but when they see, oh, my sales are going up, but my cost of goods is also going up as a percentage of sale. My net profits are going down. So when they see graphs, so you're trying to, some people are kinesthetic, some people are visual, some people are auditory. So this is where we need to combine all sort of types of elements of communication so that our clients can understand every which way that we're talking to them. Because, have you ever been in a class where you got somebody in the back of the class, never says anything and just doodles? Well, those are the people that are auditory. So they're not going to worry about a graph, or they're not going to worry about what's ever on the screen. But you got other people that are in the front of the class and their eyes are glued to the screen, and what they're doing is that they're visual. So we need to be able to communicate with people different ways so that they understand the information that we're providing them. Make sense? All right, well, it's 10:30. We're going to take a quick break.